So, what if I told you the secret to building a multi-billion-dollar empire boils down to just two jobs? Well, that's the core lesson from Warren Buffett's 1986 letter to shareholders. It's an absolute masterclass in management that you'll see is maybe more relevant today than ever before. Let's break it all down. First, get a load of this number. In 1986 alone, Berkshire Hathaway's net worth grew by nearly $500 million. I mean, that's a staggering amount of money for a single year. But as we're about to find out, for Buffett, this isn't even the number that really matters. This is the number Buffett wants you to lock in on, a 26.1% gain in book value for the year. And when you zoom out, the long-term picture is just incredible. Over 22 years, he'd managed to compound the company's book value at an average of 23.3% annually.
Right, so how on earth do you achieve that kind of legendary performance? You'd think it has to be some kind of complex financial wizardry, but Buffett's secret is honestly shockingly simple, and he lays the whole thing out for us.
Okay, so here's our game plan for unpacking all this. We're going to start with Buffett's famous two-job philosophy. Then we'll dig into how he actually puts it into practice. And finally, we'll get to the real heart of it all, how to think like an owner. All right, let's dive right into the core of Buffett's strategy. This isn't just some passing thought, it's the philosophy that he and his legendary partner, Charlie Munger, have built their entire empire on.
And here it is, straight from the man himself. You know, most CEOs are juggling 1,000 different things, putting out fires, you name it. But Buffett, he simplifies his entire role down to just two fundamental responsibilities.
And there they are. That's it. Job number one, find great people and let them do their thing. Job number two, take all the profits those great people generate and reinvest it. Wisely. Sounds simple, right? But the real magic is in the execution. Let's tackle that first job. So, job number one isn't about being some kind of micromanager or a typical boss. Nope. It's about finding the absolute best people, and then, this is the crucial part, getting out of their way. Buffett has this perfect analogy for it. He says, look, you wouldn't tell Jack Nicklaus how to swing a golf club, would you? Of course not. It's the exact same idea in business. You find the very best, the legends, and you let them do what they do best. It really all comes down to trust. You know, this whole idea of hiring the best is something Buffett actually picked up from the advertising guru David Ogilvy. The goal is to build a team where you're surrounded by people who are smarter and better than you at their specific jobs. That's how you create a true company of giants. And listen, this isn't just some abstract theory. In his 1986 letter, Buffett literally lists his roster of giants, people like Chuck Huggins running See's Candies and Stan Lipsey over at the Buffalo News. These were the folks in the trenches, running the businesses day to day and driving Berkshire's insane growth. I mean, just take Mrs. Blumpkin or Mrs. B, the founder of the Nebraska Furniture Mart. At 93 years old, she was still working 7 days a week, from open to close. Buffett joked that competing with her was a triumph of courage over judgment. That's the kind of passion he's looking for. People who absolutely love what they do and run the business like they own the place. Okay, so you've got all these amazing managers running their businesses, making tons of money. Now Buffett and Munger have a new, and you might say a pretty good problem to have. What do you do with all that cash they're generating? And Buffett says this is actually the harder part of the job. So how did they find places to put all that money? Well, the story of how they bought Fetzer, a uniform company, is a perfect case study. It didn't come from some fancy Wall Street banker. It all started with a simple letter from a shareholder who knew exactly what Buffett was looking for. And the reason that shareholder knew is because Buffett is incredibly transparent about it. He literally publishes his acquisition criteria, his shopping list, in his annual report. You can see how it all connects back to his first job. He wants management already in place, and he wants simple businesses, because he's not looking to parachute in and run them himself. Fetzer just ticked every single box. All right, now we get to what I think is the most important lesson of the whole letter. After explaining his two jobs, Buffett basically gives us all a masterclass on how to really analyze a business, and it all boils down to one simple, powerful idea: thinking like an owner. And to make his point, Buffett sets up a little puzzle for us. Imagine two companies, let's call them Company O and Company N. They have the exact same revenue, but look at the bottom line. Company O made over $40 million in net income, while Company N only made $28.6 million. So which one would you rather own? Here are the raw numbers. Identical sales, but a nearly $12 million difference in profit. Now, according to standard accounting rules, what they call JAP, Company O looks like the slam dunk winner. But is it really? And here's the twist. They are the exact same company. The business is called Scott Fetzer. Column O shows its earnings before Berkshire bought it, and column N shows its earnings after. The business itself didn't change one bit, but the accounting rules did, creating these non-cash charges that made the profit on paper look way smaller. So the huge lesson here is that reported earnings, the number you see on the news, don't always tell the real story. Buffett's solution is a metric he came up with called owner earnings, and it's pretty simple. You take the reported profit, you add back any of those funny non-cash charges, and then you subtract the actual cash you need to spend to keep the business healthy. That's the real profit.
This is the key takeaway for any investor. Don't get fooled by the official accounting numbers. The true value of any business is the actual spendable cash it generates for its owners, year in and year out. That's it.
And this whole philosophy is built on a very long-term mindset. Buffett calls it his till death do us part policy. It's the complete opposite of the frantic, hyperkinetic world of Wall Street, where companies are treated like trading cards to be bought and sold in a flash. And that contrast is just so stark, isn't it? While so much of the market is obsessed with short-term gains, quarterly reports, and just constant activity, Buffett is playing a completely different game. He's not buying stocks, he's buying businesses for keeps, and giving his managers the freedom to focus on what really matters. So that leaves us with a final question to think about. In today's world of constant disruption, restructuring, and relentless short-term pressure, is Buffett's beautifully simple two-job philosophy still relevant? Or is it maybe the timeless wisdom that we need now more than ever? What do you think?